In this lesson, we're going to go over the balance sheet of a company and specifically focus on the asset side, the first part of that balance sheet. Now, in the previous lesson, we went through the income statement and we looked at Apple's filings with the SEC and saw how our own income statement was similar to theirs based on theirs conceptually, but we had a few differences there. And we also compared that income statement to what you might see on your own personal income statement, looking at how you might earn salary and commissions, and then pay expenses like food and transportation, pay for depreciation on your house, not really pay for it, but reflect it somewhere on your own personal income statement, and then have an after-tax income, net income, here at the end of the period, at the end of the year, or the end of the month, or the end of the quarter. So the next financial statement you need to understand is the balance sheet. Whereas the income statement shows you the revenue and expenses of a company all the way down to the after-tax income or net income at the bottom, the balance sheet shows you a snapshot of the company's resources at a certain point in time. So on your own personal balance sheet, examples of resources at your disposal might be cash in your checking account, which we're saying is $20,000 here. You might have friends that owe you money, IOUs from friends, you've gone to events, you've paid for things, and they owe you money, you're waiting on that, and as soon as you get that, it's going to boost your cash in your checking or savings account. An insurance policy you own might also count as one of your assets, one of your resources, because it has value, it's going to deliver value in the future should something happen to you or to one of your possessions. Cash in your savings account could also be another type of asset here because it's a resource at your disposal. You can use it to purchase other assets or to make other investments. And then you might have assets that last for a longer time period, such as stock market investments, your house and car, or even a retirement savings plan. So these are examples of long-term assets versus the current or short-term assets listed above. Now on a personal balance sheet, there isn't necessarily a tremendous difference between these, so this example doesn't exactly follow what happens to real companies, to Apple in this case. But the basic difference is that current assets generally last for under a year, whereas long-term assets last for over a year, and sometimes much longer than that, 20 or 30 years, and even for something like a car that's going to last for longer than a year, it's going to last for at least a few years there. Now you'll notice here that I have these columns previous and current. With a balance sheet, it's very important to note that it does not show you what happens over a period of time. Instead, it shows you what happens at specific dates. So for previous, for example, if we're looking at this over the course of a year, previous might correspond to January 1st, and then current might correspond to December 31st of that same year. And this is exactly what your resources would look like on January 1st of this year and then December 31st of this year. So a balance sheet is never showing you what happens over a period of time. It's only a snapshot at a point in time. Now generally, in investment banking and really any type of industry and finance, what you're trying to do with the balance sheet is figure out what the new version looks like. So you're taking historically what the company has done, and then through your work in the model, you're trying to figure out what the next version, the new version of the balance sheet will actually look like. Now if we go into Apple's filings quickly and look at their financial statements, I pulled up the balance sheet here on page 2 of their financial statements. We can see the overall structure of their balance sheet. I'll zoom out now. We have assets here at the top, their resources, and then liabilities and shareholders' equity. Liabilities and shareholders' equity correspond to how they acquired these resources, these assets in the first place. And then, of course, the assets represent resources. By resources, I mean anything that can be turned into cash or anything that is going to generate revenue for the company in the future. In this video, we're going to focus on the asset side, and then the next one, we're going to tackle the liabilities and shareholders' equity side of the balance sheet. So you see here, they have a current and previous period for the assets, September 25th, 2010, and then September 26th, 2009. So in investment banking, what we would generally do here is start with the 2010 numbers, the current numbers, and then try to figure out what the numbers in the next period here are going to look like. We don't bother trying to reconcile or figure out how 2009 links exactly to 2010. We are only concerned with the most recent period and then projecting that, coming up with estimates going into the future for the balance sheet. Now the overall structure here is very similar to what we have on our own balance sheet, but I have made some changes. We have cash at the top, very similar to cash in your checking account on your own personal balance sheet. Short-term marketable securities are also similar to cash in that they're very liquid. You can easily turn them into cash. accounts receivable. These are very similar to IOUs from friends that we went through in the personal balance sheet example. Inventories. These are anything that can be turned into the products that the company sells. So in the case of Apple, inventories might correspond to, for example, the parts that are used to make iPods or iPads or iPhones or laptops or desktops. They order the parts, they keep those parts in inventory, and then when time comes to actually sell the products, to manufacture and sell the products, they take those parts away from inventory, and then back on the income statement, they would then be reflected under cost of goods sold when the company actually goes to sell the products. Deferred tax assets, I'm going to save this for the next video and we're going to address deferred tax items there. But just for now, the basic idea here is that with deferred tax assets, the company is basically receiving a tax benefit in the future. So in the future, they will have to pay less in taxes than the government would ordinarily require. And these can arise out of a number of different circumstances. The most common is simply that the company overpays, and then in the future, as a result, they don't have to pay as much. So very similar to when you file your own personal income taxes and you overpay during the year, and then you get a tax rebate when you actually file your income taxes and you get money back from the government. It's a similar concept here, and deferred tax assets represent your right to receive that credit in the future. And then vendor non-trade receivables, the idea here is similar to accounts receivable up here. Non-trade receivables, in contrast to accounts receivable, refer not to customers that have bought products but have not actually paid in cash yet, but rather to income that's coming from other sources. You could also have insurance claims listed here. So let's say that some kind of disasters happen and they're waiting on money from the insurance company. That would show up here because it's not related to products that are sold to customers, but rather income that's coming from different sources. And then other current assets could include a wide variety of different assets. One of the most common ones that we see on our balance sheet here is prepaid expenses. The idea with prepaid expenses is that you pay for something up front and then you recognize that expense over the course of the year on your income statement. A classic example for both a personal balance sheet and also for a corporate balance sheet of prepaid expenses is an insurance policy. So let's say, for example, that you pay $1,200 for an insurance policy. So if you do that, that would be recorded as a prepaid expense because you're paying for everything up front with cash at the beginning of the year. And then what would happen is over each month of the year, as you recognize that insurance and as you gain the benefits from that insurance, you would record it on your income statement for that month. So you'd have a separate item here for insurance, and you'd record 100 of insurance each month. That would reduce your pre-tax income and net income here. And then on the balance sheet over each month, that prepaid expense column of 1,200 here would also decrease as you recognize more and more of that on your income statement. So that's an example of a prepaid expense. The difference between accounts receivable and prepaid expenses. First off, accounts receivable relates to the revenue side, whereas prepaid expenses relate to the expense side. Accounts receivable relate to services or products that you've sold and that you're still waiting on payment for, whereas prepaid expenses relate to things that you've paid for up front, but which you're still waiting on the actual service or product to be delivered. So in a sense, they're sort of inverses of each other, and accounts receivable relate to revenue and things that have already been delivered, whereas prepaid expenses relate to expenses and services or products that you're actually waiting on. Other current assets could include a wide variety of different things. Sometimes you might see short-term securities that you've bought, so stock market investments, for example, you might see those listed here. You might see other types of prepaid expense categories listed here. You might see deferred tax items listed here. So this is sort of a miscellaneous category that includes a lot of different types of assets. Now on the long-term asset side, we see a couple of the items here: long-term investments, property, plants, and equipment, goodwill, other intangible assets, and then other long-term assets. If we go over to Apple's statements for comparison purposes, we see that they have basically the same exact categories here, so we have stuck to their balance sheet pretty closely. They have long-term marketable securities, property, plants, and equipment, goodwill, acquired intangible assets, and then other assets. And if you want, you can go over and look at the magnitude of all those items on the side as well. Since we're so close to Apple's own balance sheet here, I'm going to, for the explanation, just go back to our own Excel model. So, for long-term investments, the easiest way to understand this is anything that comes due in over a year. So anything that is relatively liquid in that it can be sold more easily than, say, a house or another company that you've bought, but which is far less liquid than cash or a simple money market account or a simple savings account or something like that. So, on your own personal balance sheet, an analogy might be stock market investments. This is actually not the best analogy here, but this is one way you can think about it. The issue is that usually, depending on how you've structured them, these are very, very liquid and you don't need to do anything special. So a better analogy here might be to say that this represents restricted investments that require a year or more of work to actually withdraw and to turn into cash. For property, plants, and equipment, this is very similar on a personal level to owning a house and a car. It's any type of property that the company owns, any type of factory they own, any type of equipment they own. So in the case of Apple, they may not necessarily own their own production and their own manufacturing facilities, but they do own their own headquarters, and they do own their own computers that are used internally for software and hardware development. So that's what an example might be for Apple. Now, usually for technology companies in particular, this category is not large. It would be much bigger for a manufacturing company or for an oil and gas or an energy company. But if we look on Apple's balance sheet, we can see that it's actually fairly sizable for them, around 4 or 5 billion here out of an entire balance sheet on the asset side of 75 billion. The reason it's larger for them is because they are a hardware company and they're also fairly large. If it were a pure software or internet company or something like a consulting or services-based company, this account would be much smaller. The next two items on here, goodwill and then other intangible assets, which again, Apple has called acquired intangible assets here. So these two do not have an easy to understand real world analogy, so I'm not even going to try to make an analogy over here on our personal balance sheet. Instead, the idea with goodwill and other intangible assets is that when you look at a company, especially a technology company like Apple, the company has value in the sense that it has cash, it has these other current assets, anything that you can touch is categorized as a current asset and listed right here. So inventory has value because it's a physical, tangible good, and if you wanted to, you could go sell it to other people. The same with cash, and perhaps even the same for accounts receivable and the other items here. The same applies for long-term investments and then PP&E, or plants, property, and equipment right here. But goodwill and other intangible assets represent value that lies in things you cannot touch, so things that are not physical. Examples, going to the bottom here, would be patents, copyrights, trademarks, contractual agreements. Other examples would be brand name, so the name of Apple in this case, the name alone and its reputation are very valuable. Customer relationships. So these are some examples of goodwill and other intangible assets. Now I've gotten some questions on what the exact difference is between these two items, goodwill versus other intangible assets. One way you can think about it is that goodwill represents anything that will be useful forever. So for example, the company's brand name, unless something catastrophic happens, this will probably be good for a very, very long time, or at least for a period that you cannot measure. Whereas intangibles expire or become useless after a point. So examples for intangibles might be trademarks, which expire after a certain point in time, or even any of the items listed right here. Patents, copyrights, contractual agreements, anything like that. So that's one way you can think about it. The truth is that in investment banking, though, you don't really think about it in these terms. Both of these items, goodwill and intangibles, arise from acquisitions of other companies. Now we're going to get into exactly how this happens in future lessons. For now, I just want to introduce this concept and state that this is how in 99.9% of cases you actually get goodwill and intangibles on the balance sheet. And these represent intangible assets, brand name, customer relationships, contracts, and so on that have been acquired from other companies. And so that's what goodwill and intangibles usually represent on a company's balance sheet. So that's how you can think about the difference. But again, I would not get hung up on this because For the most part in investment banking, it's not something you really think about, and it does come into play later on. We will get into it in the more advanced lessons in this course, but that's how I would think about it for now, especially if you're new to this and haven't seen these before. So moving back up, we're almost done now. The last long-term asset here is other long-term assets. Again, very similar to other current assets, anything miscellaneous that doesn't belong elsewhere on the balance sheet. So on a personal level, for your personal balance sheet, an example might be a retirement savings plan. It's not liquid because it takes some effort to withdraw money from there. You're going to be penalized if you do so, and it might take you years to get everything out. Other long-term assets, similar for a company, it might include other types of long-term investments, and it might include other deferred tax type items. Anything else long-term that does not belong anywhere else on the balance sheet, anything that's going to take more than a year or a lot of effort to actually turn into cash here. So that's a quick overview of the balance sheet for both Apple, a company, and what the balance sheet in their own filings actually looks like on the asset side, and then our own personal balance sheet and what our own personal assets might look like. Now, as one final step here, I want to add up everything. Instead of using alt equals, I'm going to actually type in equals and then sum, because we have some spaces here. I'm going to sum up the current assets, and then I'm going to sum up the long-term assets right here, just using the arrow keys to move down and then entering equals and then sum. I'm using shift and the up arrow key to move up and to select all these. Then I'm going to close the parentheses. Then to add up current and long-term assets, I'm just going to take long-term assets, press shift to enter the plus sign right there, and then I can use control and the up arrow key to skip up to go up to current assets right there, and then enter them right there, and we have our total assets of $865,000 for this person. What I want you to do for your exercise now, very simple. It's just to follow what I did here and add up the total current assets and then the total long-term assets and then total assets. And this is just to get used to the practice of adding these up on the balance sheet. It's really important that you add these up correctly and that you include all the items here. If you don't, you're going to run into problems later on in your models. So pause the video right now and do exactly what I just did. Add up total current assets and then total long-term assets, and then get to the total assets number here at the bottom. Okay, good. So what we can do here, we could enter equals and then sum, but a faster way in this case would be to enter alt equals, the Excel shortcut for summing all adjacent cells, and then do the same thing for long-term assets, alt equals, and then to add these up, we can enter equals and then long-term assets plus, we use the control and the arrow key to jump up to the top, and then we get 140 for total assets right here. So that's how we go through and create the assets side of the balance sheet. Just to recap the most important points that we went over here. Assets represent resources that can produce revenue or anything that can be turned into cash for you. Liabilities and shareholders' equity correspond to how you got those resources. We haven't dealt with those yet. We're going to get to those in the next video, but just keep that in mind for now. Assets must always equal liabilities and shareholders' equity. So for example, in this case, total assets of $865,000, we better have liabilities and equity also equal to $865,000. For the company, Apple here, we better have total liabilities and equity equal to $140 million. The reason we need that is because resources must come from somewhere. You cannot get something from nothing, so the total resources you have must correspond to how you actually got them in the first place. The balance sheet is a snapshot in time. Usually you have the beginning of a period, so January 1st, for example, and then December 31st, the end of the period. You're not showing what happens over that period. You're only showing the beginning on that specific date and then the end on that specific date. Current assets or current liabilities correspond to anything that is going to come due or can be liquidated within a year. Long-term assets, long-term liabilities are things that are going to take over a year, things that are due in over a year, or things that are going to take a year or longer to actually liquidate and turn into cash on the asset side of the balance sheet. So that is an overview of the assets side. In the next video, we are going to go into the liabilities and equity side of the balance sheet. You're going to see some of the common items there, and you're going to see its relationship to the asset side in the balance sheet and also to some of the items on the income statement side of a company's financial statements.